Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
After listening to today's news, you'll know, first, US Treasury Secretary's stunning support for Alberta separatism sparks diplomatic firestorm, threatening the Canadian dollar. We'll analyse why this direct intervention matters now, and how it injects a political risk premium on Canadian assets and the currency. Second, IMF issues bombshell warning as AI tsunami threatens 60% of jobs in advanced economies, fueling youth unemployment fears. So we'll discuss why the IMF is calling AI a tsunami and what this dual-edged inflationary impact means for central bank policy. Third, after failing to beat the S&P 500, giants like Pimco and State Street ditch stock picking for Craftsmanship alpha. We'll explore how this failure to beat passive benchmarks could reshape portfolio construction and drive flows into real assets and small caps. The United States Treasury Secretary has just weighed in on a Canadian separatist movement, calling the resource-rich province of Alberta a natural partner for the US. In a stunning public statement, Secretary Scott Bessent said, "I think we should let them come down into the US. They have great resources. The Albertans are very independent people." Now, this isn't just a casual political comment. It's a calculated statement aimed directly at North America's energy supply chain. Actually, the US is signalling a strategic interest in Alberta's oil and gas. By calling Alberta a natural partner, the US is hinting at a desire to reroute Canadian energy exports southward, potentially increasing US pricing power over them. The core issue is the price difference between Western Canada Select, or WCS, which is Alberta's benchmark crude oil, and the American benchmark, West Texas Intermediate, or WTI. For years, Canada has struggled with limited pipeline capacity, forcing its oil to sell at a discount to the US price. Bessent's comments are essentially a strategic play to leverage these existing infrastructure choke points for geopolitical gain. A while back, we talked about how that WCS-WTI spread had become a geopolitical lever. Today's statement is Washington reaching for it. This is also a fascinating evolution of a US policy known as friendshoring, a strategy to build more resilient supply chains by sourcing materials from geopolitical allies. But what we're seeing here is a new, more aggressive version. Instead of dealing with the Canadian federal government, a US official is engaging directly with a resource-rich province. A few episodes ago, we walked through Ottawa's counter moves like Mark Carney's tariff deal with China and a Buy Canadian tilt on federal procurement. Those actions challenge the old assumption that Canada is a risk-free, always-aligned partner. We also broke down the US's escalating secondary tariff threats tied to Canada's China outreach. So, today's subnational angle fits that arc. It bypasses Ottawa, and if normalised, could invite other powers to test similar province-level channels. These comments land at a critical moment. A group in Alberta is currently collecting signatures to force a referendum on whether the province should leave Canada altogether. They have until May to reach the required 178,000 signatures. While polls show most Albertans want to remain in Canada, with a counter-petition for unity gathering over 430,000 signatures, the intervention by a top US official has electrified the debate. And to be clear, Canadian officials and Alberta's Premier have been quick to swat down any join the US talk. Canada's government was quick to respond. Federal Finance Minister Francois-Philippe Champagne shot back with a direct message for his US counterpart: "Thanks, but no thanks. We will do our own things." And believe it or not, this diplomatic friction has immediate financial consequences. The immediate effect is the introduction of what investors call a political risk premium on Canadian assets. In simple terms, when there's political uncertainty, investors demand higher returns to compensate for the added risk. This can weaken the Canadian dollar, as we've seen in the past when US-Canada tensions rise. For example, after the US announced a 35% tariff on Canadian exports previously, the Canadian dollar plunged to a 10-week low. We previously highlighted how Canada's CDS spreads widened and the country's safe haven status started to wobble. Today's clash risks keeping that repricing in place. This new uncertainty could also raise borrowing costs for Canadian governments and companies, potentially impacting everything from national debt to business investment. However, if you zoom out, you'll see this explosive exchange is just one part of a much bigger story of deteriorating relations. Trade talks between the US and Canada are currently on ice. The tension escalated after Canadian Prime Minister Mark Carney delivered a speech criticising great powers for weaponising their economic might. That speech drew a direct and public rebuke from US President Donald Trump. Recall that a while back, when Carney moved to cut tariffs with China in ways that could undercut US measures, Trump threatened blanket tariffs on Canadian goods, an example of that secondary tariff model we broke down. Against that backdrop, Besson's Alberta line looks less like an offhand comment and more like the next turn of the screw. In his own address, Trump responded with a statement that has sent shockwaves through diplomatic and financial circles, declaring, "Canada lives because of the United States." Remember that mark the next time you make your statements. It echoes the earlier warning and underscores how personal and political this has become. So, what we're witnessing here is the use of economic commentary as a political tool. This blurs the line between financial analysis and political interference, which can erode trust and increase market volatility. As we said a while back, the northern border is becoming an economic fault line. So what's next? In the short term, the key indicator to watch is the Canadian dollar exchange rate. The political risk premium we just discussed will likely keep it under pressure. Longer term, this uncertainty could create what some analysts call a sovereignty discount on Alberta's resources, potentially depressing investment in the Canadian energy sector as financiers weigh the political risks. Keep an eye as well on Canada's CDS spreads and any moves by Ottawa to double down on its Buy Canadian posture in response. And given the tariff saber rattling we've previously covered, listen for renewed secondary tariff talk if Ottawa's China channel advances. The ongoing focal point for everyone should be the price spread between Canadian WCS and US WTI crude oil. This number will be a real-time scorecard of how this geopolitical maneuvering is affecting the value of one of the world's most important energy sources. From one source of global instability to another. While politicians are drawing new lines on the map, the tech world is unleashing a force that could redraw the entire labour market. The head of the International Monetary Fund just dropped a bombshell warning at the World Economic Forum, calling artificial intelligence a tsunami hitting the labour market. The IMF's own research is staggering. In advanced economies, a full 60% of all jobs are expected to be affected by AI. Globally, that number is 40%. This isn't a distant future prediction. The report states 1 in 10 jobs in advanced economies has already been enhanced by the technology. A while back, we noted the IMF was paradoxically upgrading its global growth outlook on the back of a powerful AI investment wave. Today's warning shifts the focus to who bears the adjustment costs. Now, get this. This is an acceleration of a trend that has been building for decades. It all comes down to a growing gap between productivity and pay. For example, in the United States, from 1989 to today, labour productivity has soared by over 100%, but the real median wage has only increased by about 13%. The puzzling part is that the economic pie is getting bigger, but the slice for the average worker isn't growing at the same rate. AI is set to pour fuel on this fire. And remember, we flagged that private investment in intellectual property products just logged a 7.2% annualized jump the 5th straight quarter, so the capital is already in motion. AI pouring fuel on this fire isn't hypothetical, it's funded. But this isn't a story where everyone wins. The battle lines are already being drawn. According to the IMF, the entry-level tasks that young people rely on to start their careers are the most likely to be eliminated entirely. This is where the situation takes a more complex turn. Youth unemployment is what economists call a leading indicator. It often signals broader trouble in the economy before it shows up elsewhere. And the latest data is concerning. In the US, the youth unemployment rate has already ticked up from around 8% to over 9%. In the euro area, it's hovering near a high 15%. The real concern is that high youth unemployment can cause long-term economic scarring, reducing a whole generation's lifetime earnings and potentially leading to social instability. At the same time, the middle class risks being squeezed, with pay potentially falling for those whose jobs are not directly boosted by AI's productivity gains. This is what experts call the hollowing out of the middle class, creating a two-tiered labour market. The data shows that roles requiring AI skills can command an average salary premium of nearly 28%. For everyone else, wages could stagnate or even fall in real terms. This growing wage gap is a major headwind for the economy because it can suppress overall consumer demand. But that's not the whole picture. The IMF chief's biggest fear isn't just the job disruption, it's the speed. Kristalina Georgieva issued a direct challenge to the world's elite saying, wake up, AI is for real, and it is transforming our world faster than we are getting ahead of it. Her greatest fear is that the technology is moving so fast, It's becoming dangerously underregulated. A while back, we flagged the AI capex supercycle and platform consolidation, multi-billion-dollar default placement deals pulling power toward a few giants. That concentration risk is exactly the kind of pressure that can test AI's social license in the eyes of both regulators and the public. This touches on a critical concept called the social license to operate. For a technology as powerful and resource-intensive as AI, companies need society's ongoing approval to develop and deploy it. If the public perceives that the benefits are only going to a select few, they may demand crackdowns. We're already seeing this happen. The European Union, for instance, has already passed its Comprehensive AI Act to establish a regulatory framework. A while back, even industry heavyweights like Elon Musk were publicly calling out what they saw as unreasonable concentrations of power, another signal that scrutiny is building. This isn't a distant risk. It's an immediate investment consideration. This all begs the question, what happens next? The president of the European Central Bank, Christine Lagarde, warns this AI boom could be crippled by growing mistrust between rival economies. As tariff barriers rise, she says the global cooperation needed for AI's capital, energy, and data-intensive growth is at risk. Her words, "We are in a bind, let's face it." We previously analysed how this consolidation of US tech power is accelerating sovereign AI pushes in the EU and China. Today's twist is that the same fragmentation could choke the very cross-border cooperation the AI boom depends on. That rhymes with the IMF's earlier warning that flaring trade tensions could become the biggest macro risk even as it upgraded growth on AI momentum. The phenomenon she's describing is often called techno-nationalism. This is where countries restrict access to capital, data, and technology to protect their national interests. The World Economic Forum itself has warned this could fragment the global AI ecosystem, leading to slower innovation and redundant energy-wasting infrastructure. This is particularly relevant given that innovation is a global game. While the US leads the Global Innovation Index, China has been rapidly climbing the ranks and is now a major innovation powerhouse. A fragmented world slows everyone down. The message from Davos is clear. The world is facing a two-front crisis, a technological tsunami colliding with a wall of geopolitical tension, and the global labour market is caught directly in the middle. So, what should we be watching? One of the biggest uncertainties for investors and central banks is AI's dual impact on inflation. We're seeing AI act as a disinflationary force by boosting productivity in the service sector, while at the same time, it's massively inflationary through its demand for inputs like energy to power data centers. The International Energy Agency already reports that data center energy use is growing much faster than expected. This makes it incredibly hard for central banks to know if they're dealing with a positive supply shock or a new source of demand pull inflation. As a market gauge, the QQQ versus S&P spread we talked about a while back still applies as a read on the AI investment cycle. For now, keep an eye on two things: youth unemployment rates as a warning sign for the job market, and energy prices as a clue to which side of AI's inflationary coin is winning out. So, with all this uncertainty from technology and geopolitics, how are the pros actually navigating these markets? Well, believe it or not, for many of them, the old ways aren't working anymore. Up to 90% of professional fund managers fail to beat the S&P 500. For a decade, the pros have been losing to the index, and now financial giants like Pimco and State Street are radically changing the game. They're hunting for what they call craftsmanship alpha, and it's a direct challenge to the old rules of investing. What's really happening is a fundamental shift from simply picking winning stocks to building a smarter overall portfolio. For example, Pimco recently launched an ETF called SPLS, which combines passive S and P500 stocks with an actively managed bond portfolio. State Street launched All W, which uses Bridgewater's famous all-weather strategy. Interestingly enough, these products aren't just selling stock picking skill, they are selling portfolio construction alpha, a fundamentally new way to think about performance. The target is the massive overconcentration in US stocks, with some portfolios holding as much as 80% in US equities alone. But what really brought this to a head was the new landscape. A top executive at Pimco says that for the first time in a financial generation, global central banks are on wildly divergent paths. This creates a new landscape of risk and opportunity that passive benchmarks simply can't navigate. At the heart of this change is that major economies are no longer moving in lockstep. For instance, the US, Federal Reserve has started cutting interest rates while the European Central Bank has paused, and the Bank of Japan is slowly raising its rates. After a decade where all central banks did basically the same thing, this divergence creates massive opportunities for professional investors to find value in currency and government bond markets, a return to what they call macro-driven alpha. We previously analysed how political pressure can open a credibility gap for the Fed. In a world where the ECB pauses and the BOJ hikes, that credibility premium or lack of it can whip currencies and yield curves. Long-term inflation expectations are still stable for now, but this dispersion makes macro-driven alpha more relevant than simple stock picking. The shift is already happening. The Russell 2000 Small Cap Index just delivered its longest streak of outperformance against large caps since May 1996. Over the last 6 months, it has doubled the return of the S&P 500. The significance here is that the Russell 2000 is seen as a leading indicator of the US economy's true health. Its strength suggests that the economic expansion is finally broadening out, becoming less dependent on just a handful of mega-cap tech stocks. It's a sign of a more durable and diversified growth story. And the analysis goes another layer deeper. Experts say many investors are structurally underweight real assets. We're talking gold, which just had its best return since 1979, along with commodities and inflation-linked bonds. Just to clarify, real assets are tangible things like infrastructure, natural resources, and of course, precious metals. In an era of higher inflation and geopolitical risk, the appeal is that these assets can protect a portfolio in ways that traditional stocks and bonds cannot. This challenges the classic 60-40 portfolio. For context, gold recently hit a historic high. For Chinese audiences, it's also worth noting that the People's Bank of China has been on a gold purchasing streak for many consecutive months, signaling a global trend among central banks to diversify their reserves. A while back, we flagged the dollar's roughly 9.5% slide and gold's surge as more than a plane flight to safety. It's become a barometer of de-dollarization. Central banks have been buying gold at a historic pace for 3 straight years, and a recent World Gold Council survey showed about 95% of them expect to add more. Pair that with real-world demand buyers in China and India, even paying steep premiums for silver, and you've got a structural shift that reinforces why craftsmanship alpha tilts toward real assets. The play isn't to sell America, but to rotate out of overconcentration and into these underrepresented assets. So what's next? One key focal point is the massive pile of cash sitting on the sidelines. We're talking about a record of over $7 trillion in money market funds. This massive cash pile represents a huge source of potential fuel for the market. Watching where that money flows, whether it moves into these small cap stocks, real assets, or elsewhere, will be a key test of investor risk appetite in the coming months. And remember, we noted a while back how the dollar dipped against every major currency amid governance risk. If that theme reappears, it could nudge some of this cash toward non-US exposures and hard assets. The old playbook of simply picking US stocks is being rewritten. The era of portfolio craftsmanship, diversification across asset classes, and hunting for value beyond the S&P 500 is no longer an idea. It's the new frontline for generating returns.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.